4 classes. We teach classes at Sac State, the Renaissance Society, and it's about a 12-week course. So over the last 9 to 10 years I've been teaching out there. We developed a book that is laid out in the same level as we do for the classes. And I'll talk a little bit about the title and what we mean behind that. Bookmarker is nice. This is a nice little book too to keep for your notes and things, either in the class or anything else. When I see people that they can use these to keep your notes. There's a lot of things that happen. And then kind of fun is later we have a entrance exam. We don't have to know how you did it, but there's 25 questions here that you can go through and try to answer, and then the answers are on the back. And so they range anywhere from taxes, insurance, estate planning to investing. And then there's a readiness list. This is listed at the back of the book, but it's kind of nice to look at. Do you have everything on this list? Yes, no, or not applicable. So things that maybe you don't want to be reminded of, but they're there. It's nice to go through that list because if you can go through both pages of the list, it's possible that you're in pretty good shape as far as having looked at things before. It doesn't mean that they're all in perfect shape or not. And then the outline of the 4 classes that we have. We used to do this before COVID, and now people are just now coming back. We're brave enough to come back into it. And you'll see on the slides, I'll do a little bit of a disclosure here. Let's see, which one is this? This is educational class with all the disclosures that people always make. We're here to give you information that you can utilize for yourself. And the objective of the class is, if you do your own investing, you may pick up on some areas that are helpful to that. We'll talk in general, but then nail it down as narrow as what does beta mean, standard deviation, all these little things that have to do with a fund or a portfolio, and give you the tools that you can utilize on your own. Some people are already investing for decades, but we can get some different angles and ideas. My son Nash is here. He's more credentialed than I am. He gets into some of the numbers, but I like to get us started and do the paint a broad picture first. But we're here to talk about how you're doing your own investing. Ultimately, you need to do financial planning. You have to look at the insurances, the estate planning, and things like that. But because this is a narrowed down class, we're going to go strictly to the investments, but we'll touch on some of the other financial planning and estate planning areas. I've been doing financial planning since 1980, so since most of you were just little kids, right, in grade school. And seen a lot as you have, so I have a lot of experience and wisdom just simply by seeing people make mistakes, making mistakes, and seeing what's out there. We're not really pushing any particular investment direction. The most popular areas we'll talk about are the mutual fund area, or the newer version is the exchange traded mutual fund, but individual stocks and bonds and things like that. We'll give you an opinion on the level of risk and things like that. Let's go. Active retirement investing, obviously designed for people that want to do their own investing or not. Nash is here. These are all his credentials. But I originally started teaching the class, so I'll start it off here, and in future weeks he may get involved or answer questions for us from the audience. That's me, been in business for quite a long time, started in 1980, and have published, I think, 3 books. This is the 3rd. These are our credential backgrounds. But our big push here is whether you do your own investing or you want to check on a current advisor or family member, we need to know what's going on within your process. Make sure somebody doesn't take us in the wrong direction. I don't know how many times I've heard of a family member with good intentions leading everybody off a cliff. Have I got a deal for you? This person is so smart. He or she does options, and you got to give them all your money. And then you've seen those things before. They're intended or unintended Ponzi schemes where the person's just convinced they're going to make you a lot of money and they keep failing and guessing. I went to a coffee shop this morning, very nice little one down the way, but somebody says, "What are you up to today?" "Well, I'm getting started. I'm a day trader." Day trading is fine, but it's very risk intensive, and if you make decisions that are of a high risk or you try to predict something's going to happen that day, it may or may not turn out. So we want to help you do your own investing if that's what you choose to do, or if you want to check on your current advisor. And that advisor could be a family member or someone else that's assisting you at that point. So, hi, come on in.
Thank you.
You found us.
Yes, I did.
It took me for a while. I had to ask for help. And plus, we keep the lights out, so this isn't a strange class, but it helps out. So, active retirement investing, helping you do your own investing if that's what you choose. You can do that from your phone, your laptop, anywhere. There's a lot of entry portals to be able to do that. But we also want you to be able to check on a current advisor or family member if somebody in the family is doing your investing or helping you. Because we want to watch out for people gambling on what they think is going to happen. Gee, I think Tesla's great until it's not. And so is this a second chance? I don't know. That's why we would rather have diversity in the individual positions in the portfolios. So teach you how to check on a family member or someone else, or if you have an advisor, what he or she should be doing. In our opinion, they should be an hourly or fee-based advisor, not a commission person. But either way, they're required to look at your best interest first. The law is finally catching up to them. Need to learn where to seek advice or assistance. We'll talk about that a little bit today. Some of the goals here, because we have only 4 classes, as I mentioned, we'll focus on investing, but many of the objectives that I have with clients that I talked to over the last several years is obviously maximizing retirement. That's important, and we have to deal with insurance and what you do with a spouse or not. We have stories about all these things that will blow your mind, simply because I've talked to thousands of people. Reducing income taxes, obviously, do I do a Roth conversion or not? Our little tidbit there is make sure you do it before you start taking Social Security or Medicare, because they'll raise your premiums if all of a sudden your income goes up, right? So if you're going to do a conversion, try to do it before you start on Medicare, or if you do it after that, see an accountant. We'll talk about inflation protection. Normally, that was never brought up much. I mean, I'd talk about it, but we hadn't seen inflation over the years. And then all of a sudden, 2 years ago, we get smacked with it. Funding your children's education, estate growth, and then financing travel, distribution of assets. How do you give money away? What if you've got assets in stocks and bonds and mutual funds, and you've got kids or grandkids you want to give them money to? Do you sell that, pay the capital gains, and then give it to them? Or do you sell it, pay the capital gains, and give it to the charity? Of course not. We all know that you would gift the asset itself and avoid you paying the taxes if the beneficiaries and the recipients in a lower tax bracket. Protecting accumulated assets. There are some little tidbits in there we won't spend much time on, but as you rolled over your 401k or your TSP or whatever your retirement plan is, that new rollover IRA does have something called ERISA protection that will protect it from lawsuits, but if you commingle it with an old little IRA that isn't, you lose that. So there's little tidbits here that we want to bring up as we go. The analysis process for us, rather than sitting down and talking about some big financial plan, because doing a financial plan is extremely important. But in past years, people that sold annuities, insurance, mutual funds, and commission products would use the financial plan as a way to get you in and learn everything about you. Because they do need to know everything about you, but not just to sell you stuff, right? So we need to look at what does a financial plan entail. It would take a lot of time to dig very deeply, but on the surface, we call some of the reports diagnostic reports. It's just an analysis, a review of somebody's finances, in order to get to the point where if you want to invest, you're not going to lose the investments due to an accident, illness, a lawsuit, or something like that. So we'll look at a variety of things. Personal cash flow, obviously you do that on a regular basis. Insurance, what types of insurances can you get rid of? What do you need to increase? Estate planning, do you need a living trust, a will, a durable power of attorney, or any other legal document that somebody might need? Look at your taxes. In the book, you'll have a process of how to look at your taxes and what you might want to do. Investment in portfolios. How do we look at the investments to find something that is within the appropriateness for you or the risk levels? And with all the investments that you have, how do they create a portfolio? We'll spend a little bit more time on that, but we need to remind you, look at these other areas. Then when we look at all these areas, we'll look at a post-punch list, meaning here's a list of all the things. So as you evaluate your situation, or if I do for someone else, I want to go through all these questions of all the insurances, the estate planning documents, how's your taxes. Right now, taxes are interesting because we all fear they're going to go up, right? And the new tax law is going to reset, in a couple of years. So we're going to lose some of the tax benefits that we had, especially you multimillionaires. You can only give away, right now, 13 million, and then you'll only be able to give away 6. That's not a problem most of us have, right? But it's a good idea to stay on top of those as much as possible. Then we do the post-diagnostic and we look at that list. So you go through all these areas I mentioned, you come up with where we're a little bit weak, we need a little bit of this, or a little less of that, and then review this punch list on a regular basis. When I talk to my clients on an annual basis, I go down the list. Has anything changed? Have the beneficiaries or trustees on your trust changed? Do you still like your beneficiaries? Have you lost a spouse, been divorced? Those things change throughout the year, so you will need to, as it mentions in this book, follow up on everything that you're doing on an annual basis. The book will talk about what you'll need to do daily, weekly, monthly, quarterly, biannually, and annually, right? So we have control of your life. If you want to do all this stuff yourself, there's a list of things that you want to follow on a regular basis to keep up with that. So, and then other questions that I'll have relate to the client's background or information about their investments and things. Once you've gotten past the financial planning process, and we call them the diagnostics to make it brief so you don't have to do a huge financial plan, but the checklist, once you've gotten past that, then we start narrowing in on the fun part. What about the investments? We've analyzed the insurance policies, the state documents, and the investments, and we found maybe that some old mutual funds are high expense ratio. We need to get rid of it, but if it's not in an IRA, what kind of problem could we run into if we target an old mutual fund that's doubled in value, but it's not in a retirement account? Any ideas? About taxes, right? So you might have an old mutual fund that we feel that the expense ratio is out of line. It's like 1% a year just to own the mutual fund, but it's doubled in value over the last 10 or 15 or 20 years. And if you just sell it, you're going to pay a lot of taxes. So then you need to look back at the evaluation and see, can I sell it all at once, pay the taxes, or sell it a little bit each year and reduce that? Because I want to go buy a Vanguard fund that's got a real low cost to it in the expense ratio. So one of the investments that's out there, if you haven't utilized them already, is a mutual fund approach where you buy shares of a basket of stocks and or bonds and cash. And that mutual fund, in order to be creative and manage the money internally, charges a management fee. So if you don't want to pay an extremely high fee, you look for the lowest cost mutual fund out there. Some exceptions, but we like the Vanguards of the world, Schwab and some Fidelity and things like that. But you might have an old one that you bought years ago that 1% expense ratio was reasonable, but now it's just too high and we want to get rid of it. If you're talking to an inexperienced advisor, or you just go sell it and buy something else, boom, you've just triggered a big tax liability, right? So you have to come up with plans to do that. But once you get past all of that planning, when we get to the investment, we'll look at ways that we lay up an investment portfolio. So utilizing these mutual fund-like vehicles, the newer ones, have you guys heard of exchange-traded funds? Some not. So the exchange-traded mutual fund, as I call it, is a way to buy and sell those funds on a regular basis throughout the day, just like a stock, good or bad, but it's still that basket of stocks and or bonds and things. The old mutual fund, if you wanted to buy it, you had to send Vanguard or Franklin a check in the mail with a filled out application, and then in a week or so, you would get back a statement saying, okay, we bought some shares for you in your name with your money, with the mutual fund directly. Then years later, you could buy different mutual funds in a Schwab account or a Fidelity account or something, but there was still commissions, or if there weren't commissions, higher fees and things like that. So then came the exchange traded mutual fund about 30 years ago. We didn't hear about it much, but it wanted to just track the S&P 500, just the stock market, bring the expense ratio down like Vanguard was doing with one of their mutual funds. And they came up with an exchange traded fund that became very popular in the last 10 years. So now you can do these mutual fund-like baskets, exchange traded mutual funds, that can be traded on a daily basis inside of your Schwab or your Fidelity or your Vanguard brokerage account. So we'll talk a little bit about those later and get into the detail. But when we set up
Can I ask
this,
you a question about
Yeah.
what you just said?
Yeah.
Are you saying that you can do exchange, you can be trading stocks that are in an ETF without triggering any kind of a tax liability every time you sell? Is that what you're implying? I didn't quite understand.
no, I'm sorry. Yeah, if you have an ETF, you can't go in and buy and sell the individual stocks. In your brokerage account, you can buy individual stocks and or exchange traded funds. And if you buy and sell shares, there is a possibility of taxes at that point.
Yeah, okay, thank you.
If you own, however, an exchange traded fund, that's an index fund, similar to a regular index fund, but they have the ability to buy and sell occasionally and trade stocks with somebody else's and avoid paying capital gains. So we've all heard of, I bought this mutual fund in December, and all of a sudden I get a capital gains distribution and the share price dropped based on the distribution, and now I gotta pay taxes on gains I never made. I paid $10 a share in December. They paid me $1 dividend, which I reinvested. The share price dropped to 9, so I'm back to 10, but now I owe taxes on $1. Well, you can correct that later when you refile. It changes your cost basis, but that's a frustrating thing. Has anybody ever heard of that? Buying a mutual fund and all of a sudden paying taxes on capital gains that you didn't really make. You didn't lose anything of it, but the exchange traded fund has ways to buy and sell stocks to try to reduce or avoid that altogether. So if you have a Schwab portfolio, I'll just use Schwab as something that we're familiar with, and you have some Vanguard funds in it, some Fidelity, Schwab, iShares, anybody ever hear of them? Different funds in there. You can then buy or sell a mutual fund whenever you choose. If it's an old style mutual fund, you'll put in the order to buy it today, right now, but it won't trigger until the end of the day because they settle up at the end of the day. And then an exchange traded fund, you can buy and sell as frequently as you want. So when you create a portfolio, we want to make sure some of the funds in the portfolio relate to short-term objectives. What would be a short-term investment that people might use right now? They might want to put it in and not worry about it going up or down value and get it back.
Or if you just do cash in your, right? Or you
Yeah.
can do distributed as one of the bonds that didn't last 3-month
Yep.
CD or something like that.
Yeah, cash or money market funds that you can get in and out of, or very short-term CDs or bonds. So if you have this big portfolio, or you have 3 separate accounts, some money is in cash just in case you have an emergency or opportunity that you need some money, right? And you don't want to go to it and see the market drop. Stock market's at an all-time high, but we're all old enough here that we've seen it drop significantly. In 2008, it was down 65% within the year and ended the year at about a 50% decline. So if we have some money in short term, like most everyone does, put it in the bank and have it there available for you. It's available without loss. But in the long term, it'll lose a lot due to inflation, right? It won't grow much with inflation, but we're stuck. If we put it into a long-term Standard & Poor's 500, S&P 500 fund, it could be down 30% like it was 2 years ago. And now it's up a lot. So we need to have some money in the short-term basket and then some money in the intermediate-term basket, meaning any of these baskets I can cash out any day I want. But there could be consequences that if I buy into something volatile and the market crashes, I don't want to lose all that, right? So I've got some money in cash, CDs and things I can get my hands on. Then I've got some money in more stable funds like short-term, intermediate-term bond funds that don't have too much volatility, or a balanced fund that has some short-term bonds and a little bit of stocks. But the main thing is if I go to pull money out, it might take some bruising, but I'm not going to lose too much. So the short-term money I can get in and out any day without any loss or very little. And the next basket, the intermediate term one, we don't intend to touch that for, let's say, 3 years, 3 to 5 years. And if I don't touch it for a couple of years, the dividends are reinvesting. And if it drops a little bit, I'll still come out whole at the end of 3 years or so. I could get it earlier. There's no strings attached to these investments. You get in and out. And that's a warning sign. Don't get into anything that you can't get out of immediately, or maybe in a day or two. But we don't like long-term commitments in some annuity that has a 10 or 15-year surrender charge. The fees are going to make the insurance company rich. We don't like limited partnerships where you don't know what they're doing and the general partner makes sure that he or she gets paid, but at the end of the day, if there's any money left over, you may get some, but we haven't been very impressed with limited partnerships. There may be some exceptions to that. And then real estate investment trusts, has anybody ever heard of those? You go to a nice dinner and everything, but they're front-loaded, meaning you go in, they take 10% of your money to pay commissions, attorneys, CPAs, and you've got 90% to be invested or less, and it's very difficult to make it. So we would say when you're investing, stay as publicly accessible. You can get in and out, and it's regulated by the Securities Exchange Commission. No guarantee you won't lose your shirt, but hopefully it reduces the risk of fraud. Then on the third bucket is the long-term. So we talk about short-term, intermediate, long-term, or phase 1, 2, or 3. And the long-term bucket are investments that are still liquid on a daily basis, but they're very volatile or moderately volatile, depending on what you want to do. And those might be individual stocks, although we would prefer to be in a basket of stocks, like the S&P 500 you've heard of, or some other types of stock-related funds. And so you've got money in this one big Charles Schwab account, or separately, but short-term cash, intermediate term, I can take some bruising, a little bit of a loss if I come back and panic and need to liquidate it. And then my long-term investments, I can get out any day I want, but they go up and they go down, and I might pick the wrong day to sell. So we need to leave them alone. So this first basket is 0 to 3 years. Second might be 3 years to 5 years objective, not stuck there. And the next one might be 5 years and beyond. And so therefore, if I have an emergency, I can go in and liquidate from phase 1 if phase 3 is down. It's just it's a responsible way of watching out, putting bumpers on our little vehicle and having a seatbelt and an airbag. So we recommend the mutual fund concept, or more specifically, the exchange traded mutual fund, and in a basket with several different funds in that basket. When we'll look at this later, we look at something like a pyramid. Most of the funds in this basket, we might have 10 or 12 in there. We would like most of them to be low-cost index funds. Have you ever heard of an index fund? So those are the ones that will buy one of everything in whatever index. We all could create the baby boomer index today. What's that? Well, let's figure out the top 100 stocks that the baby boomers might, companies they might utilize more. And then we listed 10 companies that the baby boomers utilize the most. And if we think baby boomers are going to start spending money in the future, then we create an index with those top stocks. And then when we create the baby boomer index, you set up a fund matching our little franchise here. And then if Vanguard likes it, they can copy us, but they got to pay us a fee. Fidelity likes it, they can copy it, and they can do the baby boomer index, but they have to pay us a fee. And so that's why we create the index. So when you see the S&P 500 index, total stock market index, somebody has created an index and a list, and they keep it up to date all the time. And the big mutual fund companies, the Vanguards and the Fidelities, pay them a fee to copy that. And then they say, look, we've got an S&P 500 fund, come with us, and we'll buy all the 500 stocks, lay it out just like that index publication that we're tracking, and we'll keep you up to date. And for that, we'll charge you 0.25% or 0.1%. Some could be more if what they have to do is a lot more work. So a mutual fund is a basket of stocks and bonds, pretty much. And why would you do that? Because we don't want to buy an individual stock or bond. The risk is just too great. Some people were all excited about Tesla when it hit a peak, and then now that it falls, the human behavior is, I want to go and follow the crowd all the way up to the cliff, and that could be a problem. What's a big stock that people are talking about now? Have we heard of NVIDIA? They've been around for quite a long time, but now is their time, right? And AI is very popular. Companies are ordering, I assume, chips from this company, and they're getting a lot of business, but people feel there's still a lot more room for them to grow. But that's the question. Should I jump on board when it's already gone up substantially? And does it grow more? Or if I buy it and there's a slowdown, will I lose money? So buying one stock is, for me, not a wise thing to do. I'd rather buy a basket that has 100 or 500 stocks. Or if I want a stock that does technology, maybe I'll pay a little more of a management fee for somebody that knows what they're doing. They can buy those things. So the lateral integration, short-term, intermediate, long-term objectives and funds in there. I can get in and out, but I'm going to leave this stock fund that I promised myself, even though it's down 20%, that's in the long-term bucket. Leave it alone unless there's something wrong with it. And then the short-term money, it's not going to grow much, but it's there for an emergency. So even if inflation goes up or I don't earn much compared to what the stock market could have done, don't beat yourself up. That's my emergency fund. So on the financial planning arena and concept, if we do things like that properly, you come out at the end getting the best rate of return, the safest rate of return based on your risk tolerance and liquidity needs. But we, if we're responsible, will never end up being interviewed saying, you borrowed all the money on your house, you put every dime into this stock and it went way up. Tell everybody how you did it. Well, you gambled and you risk losing everything you've got. So in the financial planning arena, we're never going to beat the market altogether because we're too well diversified at that point. So time frame and then the vertical integration, baseline low-cost index funds that you'll learn a little bit about. And then the next level is a little bit higher cost managed and especially index funds and then managed funds at the top. We'll learn a little bit about what that is. But you don't want to go out and try to buy what's popular or what somebody says you should get into. Those are the things we should stay away from. If you want to go do your own thing, you could call Vanguard and ask them if somebody will talk to you. Or you could look for a local advisor if you've inherited or you've accumulated money, you want to make sure you do it right. We'll teach you that we want that person to be a fiduciary, somebody that's required to put your needs first. Once you get going, if you get into the investment process, or if you have a family member, or you've hired an advisor, then these are the things that we need to do on a regular basis. We have them backwards here a little bit, but daily, obviously you want to watch what's in the news, right? Is there much news out there? It seems to get more radical every day, doesn't it? More crazy, but maybe we're getting older and stuck on our ways and it's just we don't like change, but there's crazy things regardless of what side of the aisle you're on. But what we do and what if you do your own investing you might want to do is keep an eye on what interest rates seem to be doing and where the Fed says we think we're going to raise or drop them. Now that's political as well because they said they were going to drop interest rates a while ago and they haven't done it yet. And if you drop interest rates, that allows you to borrow money more cheaply, correct? People buying cars, houses, and that can stimulate the economy. But if you bring the rates down too low and there's too many people buying and selling, what happens to the price? Goes up. So some of us will argue that the Fed kept rates too low for too long, and then they raised them too high too quickly. We can argue about that all day long. But the main thing is to be aware of what's happening. So watch the news. And if you were going to buy a house or help the kids buy a house, what are we looking at? Where interest rates, are they going to come down? Should we wait to buy the house? Maybe sales aren't happening as much. Prices might fall a little bit. That affects the economy. So the Fed has pressure on them to say drop interest rates so we can increase real estate transactions. you'll never really get everything figured out 100%, but you try to go in the right direction. So Daly, you want to know what interest rates might be doing in the future, where they are now, should you refinance or not? Obviously, most of us probably should not. Why would you not want to refinance now, possibly?
Rates are too high.
They're too high, and your old mortgage is probably 3.5%, right? Why would you get a refinance at 6? If you need some money, you could get an extra little loan or something like that, but we want to stay away from that. So very good point. But young people, it's unfortunate now because they're having to pay 4 or 5 times their yearly earnings for a house. And years ago, it might have been 1 or 2 times earnings, but it's really tough now. And with rates having gone up, prices haven't fallen. Remember back in the 90s, interest rates went up a bit and prices immediately fell. That was perfect if you could afford to pay those high interest rates. Because, I'll put this trick question to you, when's the best time to buy a house with a mortgage? When interest rates are as high, super high, historically high, or historically low? Trick question. If you bought the house when interest rates were super high, like 18%, you guys are too young to remember that, right? Back in like the late 80s or so, early 80s, mortgages were like 16%, let's say, and higher. But the price of the house was like 1/10 of what it is now. So if you could afford to pay those ridiculously high interest rates and buy the house that's dropped in value, compressed down because nobody's buying, then you got a really cheap house, but now your mortgage is outrageous. But interest rates are as high as they're ever going to go. What do you do when interest rates fall?
Refinance.
You refinance. So you bought the house at a super cheap price. A few years later, now you've got a reasonable mortgage on it, but the house then goes up in value because now other people can buy it at a reasonable payment. So if you want to make the most profit in the shortest period of time, you have to be a contrarian and do the opposite of what other people are doing, or at least plan it out. And right now, we're all confused because interest rates are, according to what I'm used to, still low. When I started in business in 1980, I'd interview people, what's your mortgage at? 7%. We would giggle. That was ridiculously low because new rates were at 13%. So I don't know that rates are going to go down a lot, but it would be nice if they went down a little bit to give a little help to the lower middle class people that want to buy a house and things like that. So daily watch what's going on with the news and things. Obviously also taxes. If you ever had a lot of money in a retirement plan and you'd like to convert it to what? Convert your retirement IRA to what IRA? Roth IRA, right?
Yeah.
Because you'd like it to continue growing tax-free. But there's a catch, right? When you convert whatever amount from your IRA to the Roth, that is taxable. And that's why we say watch out for Medicare, because they'll raise your premiums for the next 2 years. So see your accountant and see how much you can convert without triggering Medicare or other tax liability. Right? And what would be the pros and cons of doing a Roth? This is that tax evaluation, all that kind of stuff. Well, maybe if your income might go up in future years, you convert it right now and pay the lower tax because tax rates might go up. And rates might very well go up even if you wouldn't have expected yours to go up, right? Because the country's in dire straits with the budget and all that kind of stuff. So if you're at a moderate tax rate now and you don't expect to be in a personally higher tax rate, there's still the chance that they could raise taxes on you and your rates go up in future years. So then you might want to convert your rollover IRA to a Roth right now. But the catch is all the taxes you pay, and would you trigger higher Medicare when you get to the point that you draw Medicare? So do it before that. So now we're like, oh, but Bill, you said converting was a good thing, but now it's a bad thing. No, it's back to a good thing. That's the dilemma that we'll all have. Should you convert? Will taxes go up in the future? We all assume they will, but maybe the politicians won't let that happen and we'll go off a cliff. At some point we'll be like Italy had problems when they couldn't pay the bills. So maybe we have another 10, 12 years, no more taxes, and then we fall off the cliff. Maybe they need to come up slowly in different areas. We'll see. So weekly, we want to keep an eye on what we're doing with the investments. And if you have investment funds, you might get an alert, something telling you, oh no, this investment fund's changed, or they're going to distribute a big capital gains, or they got sued by the SEC, Securities Exchange Commission. So we keep an eye on the things I mentioned before. Weekly, we keep an eye on the individual investments and see if we get in any reports that they've got problems and we need to get out of a fund. Maybe they've changed their objective, maybe they raised their management fees, maybe they're in trouble and got fines. I've had clients where I've gotten out of a fund that was performing really well, but its home office managers got a violation from the SEC for putting big investors before little investors. And so we just left that fund company in that group and went to some other group. So weekly, what's the individual fund, any alerts and any problems? Monthly, we want to take a look at what's out there and do exactly what you're doing right now. Because you have the ability, after taking this class or reading this book or watching other videos, and we do have classes. How many classes do we have on the website?
7.
So we have 7 of 12 classes where Nash teaches them at Sac State, and you can follow them again if you want to and go into greater detail. This is kind of a little teaser class. It's only 4 classes, but we'll see if we can get him to come up and talk about some things in the future. But on a monthly basis, what we do is try to shop for the funds with what you're learning, and all of a sudden, if you come away from here saying, whoa, I'm going to take this over myself. If I don't want an advisor and I don't want to be too complicated, I'm just going to learn all about, let's say, Vanguard funds. They're a big group that if you were to do any one mutual fund company sponsor, I'd start with Vanguard, but then you get on the phone, it takes 20 minutes to talk to somebody and it's confusing. If you have a fair amount of money, then you may want to just take more classes, read more books, and or hire somebody, only a fee, not a commission, to help you with that. So those are the layers. But on a monthly basis, you should be looking at all of the investment funds out there if you're doing it yourself. And if you're not, whoever's helping you and your family or an advisor should be scanning through the different funds on a monthly basis. Are you allowed to give me an opinion or tell me what you look for when you're looking at funds?
It depends on what context.
Let's say you're an investor and you learn how to look at something called Morningstar, looks at different funds and gives you an analysis and things like that. So if you were just beginning and you were going to create a portfolio, if you were to look up different funds to try to put in the portfolio, what things would you look for?
Again, that's gonna mostly depend on what the portfolio it is that I'm building, but for the most part, I would wanna find things that are relatively low cost, like you mentioned before. Like expense ratio on a fund is what you're gonna be paying year over year for those fund managers to manage for you. I'm also gonna wanna look at some relative volatility measures because I wanna know how much is this gonna go up in any given year. Is it gonna be really volatile? Am I going to be seeing 20-30% declines in advances, or is it going to be something more stable? Things like that, and different things that I would use to put together. The other thing that I would want to look for is that they have a lot of individual positions inside of themselves. So I don't want them to be too concentrated on any particular stock. So something that I was looking at recently for a client account, they do like a lot of low carbon emission investments. They like a lot of like politically in some sort of progressive way. They like investments that move in that direction. But one of the things that I noticed that one of the funds that they were in that was performing relatively poorly was 10% of that fund invested in Tesla, which 10% doesn't sound like a big number at first, but really when you look at it, that makes a really, really, really big difference on the returns of that fund. So if we have a position that is 10% the size of your fund, that's going to make a huge difference in the way that it moves, especially when it's something as volatile as Tesla. Because Tesla, I mean, we've seen it go like $200 to $1,100 to like just ridiculous price swings because of things that just don't seem to make a whole lot of sense on a fundamental standpoint. But that's another thing that I'd be looking for, is diversification.
Yeah, and he'll go to columns of thousands of funds and reverse search it and I assume look for the lowest cost funds first, and those will usually be an index fund that buys one of everything, and they don't do a lot of management. But then he may look at factor funds that may get off in the weeds here a little bit to help protect us from volatility. For example, instead of all stocks in the S&P 500 fund being weighted towards the biggest companies, he might find an S&P 500 fund that's equally weighted, where Google's not, and Apple's not the biggest position of 5 or 6%, but maybe it's 1/500th, everything's equal. So there's a variety of different funds that he'll look at, but you'll shop new exchange-traded mutual funds monthly, because those give us a little bit more agility to buy or sell, and also historically, the trend is they're lower expense ratios. And you could have an old American funds mutual fund, or an old Putnam, Vanguard, all these different ones, not Vanguard, Franklin, these higher cost mutual funds that charge you 1% a year after they charged you how much commission?
Oh, like 5.75%.
Yeah.
Yeah.
In the old days, that's all we had, unless you had a brokerage account at a Merrill Lynch, is you had a broker. And if that's the only way you got to invest, then he or she made 5.75% commission. And so when you bought a mutual fund, it was worth 5.75% less if you sold it. But if you kept it over time, that lower amount came up to the full value and beyond. Because in the old days, you bought a mutual fund at American Funds or Franklin or somebody, and you kept those mutual funds for your whole life. So that first commission spread out over several years, and 10,000 grows to 100,000, it wasn't much. But if you want the ability to move around, you don't want to be paying 5.75 here and 2 years later go somewhere else and pay it again. And plus, those companies had high expense ratios. But that was the norm back then. Now, people are expected to do more on your own, and you can get these funds at a lower cost. So he'll look at the categories of, let's say we want a growth fund. He'll look at all the parameters of what is a best growth fund, not just the low expense, but the history. Do you have any funds that you like, but that have a higher expense ratio?
Yeah, there is a particular one that I've been looking at a lot. So historically, one that's performed really well is called T. Rowe Price Capital Appreciation. However, that's been closed off to new investors. So that might be something that you find in your old funds a lot of the time that's done really well, but it's not available to people now. But what they do have is one that's called T. Rowe Price All Cap Opportunities Fund, or something close to that. And what they do is they look to find companies with a lot of growth potential of pretty much any size. So there are some growth funds that'll bias towards the larger companies, some that'll bias towards the smaller companies, but they just kind of go across the board, whatever looks like the best opportunities for them. And historically, they have done really well compared to their category. In fact, the growth category in Morningstar is one of the toughest categories to beat, and they have done so year over year. However, you are paying about 85 basis points, and a basis point is a percent of a percent. So you can think of that as 0.85% year over year. But even with that fee, you tend to get some overperformance compared to the category.
Yeah, that's a fund that they actually do what they all say they do. Because I always have a hard time figuring out what makes a good basket of securities, a mutual fund. And if they do well year over year, they must be doing something right. So he'll look at the long-term track record, the expense ratio, what they're doing. And if he's going to have a couple, out of 12 funds, he might have 2 or 3 in these higher expense ratio, but they're doing something that's well worth it. It's kind of like if you owned a bunch of real estate properties, one manager went out and did the work and maintained the properties and kept the rents up, and the other one just collected the rents and took a fee. There are not very many, or in your opinion, are there very many managed funds versus index funds, meaning where they do this stuff versus they just buy one of everything, where it's worth paying the fee?
Not on a consistent basis, no. It's a pretty small number.
Yeah. So you do want to keep the fees. If you only had one thing to choose, and it was kind of get the lowest cost fee in an index fund, that's where we would say to go. Because your core funds are lowest cost, right? Mm-hmm. And then some of these on the outside that do something special with a higher expense ratio, that's fine. It's kind of like if there finally are exchange-traded mutual funds that can buy Bitcoin, right? But most of us roll our eyes and say, I don't want anything to do with that. But let's say you wanted to have some Bitcoin, but you didn't want to risk losing the password, losing the coins, you didn't know anything about it. Or Bitcoin and Ethereum, is that the other one?
Yeah.
Maybe a fund that does a couple different of those. And if you wanted to be involved, I'd be more than happy to pay somebody a fee to manage it, because I don't have a clue. And so if you have a fund out there that goes further out on the limb and they're actually doing something for you, then the fees is no object, doesn't matter, but you're getting something in return at that point.
Can I ask you a question?
Sure.
You said if you went to Morningstar, you could do a search for all the parameters that Nash was suggesting, the 10 or 15 or 20 characteristics that you want to be used to evaluate for mutual funds. Is the same search capacity in Morningstar available for exchange traded funds? Or where do you go to shop exchange traded?
Yeah, that will apply to all types of investment securities. So mutual funds, exchange traded funds, and even individual stocks, you'll be able to look at the same data points.
So they might even have something like your baby boomer ETF 10 top.
Oh, yeah, definitely.
Yeah. They have.
Adult diapers and
There you go.
Exactly.
whatever else.
I'm gonna buy mine early. Yes, there's a page with thousands of indexes that people like us created, and they're hoping somebody will pay them the royalty or whatever, subscribe to it, and then create the funds. So there's thousands of indexes out there. And like I say, an index is just made up. Let's create an index and let's track this. The Dow Jones Index started with probably 5 or 6 railroad stocks in the turn of the century or whenever, and now it's 30, right? And it's not a good index to follow, but I don't know why we always follow the Dow. I follow it every day, and it's really not a fair representation of the broad market. We'll look at the New York Stock Exchange, which is a little bit more diversified and not just the top 8 technology stocks like in the S&P 500. S&P 500, should you get in or out? I don't know. You might start feathering out a little bit and move into something a little different or a little more conservative, but that's the fun part about the planning process and the investment process. We don't know what the future is going to bring. I watch the people talk every night. This person says the market's going to crash. This one says, no, it's going to keep going up. And so you have to kind of find that balance for what your particular financial situation is. We don't want to chase somebody else's dreams or opinions, but it is good to have somebody have a strong opinion if it makes sense for your particular situation. So on a monthly basis, he'll go to this Morningstar software and line up the columns and look for, today, maybe I need a ultra short-term bond fund to park some money in to get 5% or something. So he'll look at all those, because there's a ton of them offered, but he wants to look for the cheapest ones that have the lowest expense ratio. And that's usually Vanguard, unless Schwab or Fidelity want to compete with Vanguard, then they'll come up with another fund cheaper just to try to beat Vanguard. Because the lowest fund that I see, unless it's a free fund at Fidelity where there's no expense ratio, come on here, it's like the toaster. You get a few free funds, no expense ratio, but then they want you to buy everything else they have. Funds that have higher expense ratios or a fee to buy somebody else's competitive fund. So he'll look at that, and if he looks at a balanced mutual fund with stocks and bonds, he'll look at columns of them and determine, is this one the cheapest? Okay, it may be the cheapest, but is this other one doing a better job managing and worth the fee? So he goes over that on a constant basis. So those are the 3 things that we need to do starting there. We have these kind of in different order. But the next one would be quarterly. He'll take a look at all of the funds that the people that we work with. He has a list of all the funds that they own, and he'll look down the columns and see who's got the highest expense ratio to the lowest. And if we have a fund that has the highest expense ratio, why do we have that? And if there's a reason for that, does that reason still hold up? Or back to what he did monthly, is there a new fund that outperforms this old fund that has a higher expense ratio? We had one that does preferred stocks. They're kind of like bonds, kind of like stocks. And it was doing great all these years, and it had a high expense ratio, and it outperformed everybody. But then when the exchange traded funds offered something similar, but at a lower cost, then we screen those quarterly, get rid of the old high cost fund into a new exchange traded fund. Keep that up to date. So that's something we do on a quarterly basis, is we get rid of any of the funds that don't really match. And that's in the book. If you do your own investing, you can follow each of these little time parameters. Then biannually, this is an important one. This is a time to look at all of the funds in the portfolio, and if any of them are breaking through their normal patterns excessively high, it might be time to sell off part of that fund. So rebalance on a biannual basis and sell off what's up too much, not what's down too much, unless there's a reason. If it's down too much because it's a bad, poorly managed or has a high expense, sure, you might want to get rid of it. But if it's whatever sector might be down, a real estate mutual fund that has real estate stocks is down a lot today for all the reasons that you hear about. But maybe it hits bottom pretty soon, you may or may not want to buy that. But when you look at things on a biannual basis, if it's a good fund, good track record, but its area has tanked and it's not the fund's fault, then don't get rid of it. Unless you need a write-off, then go buy another one just like it. But if it's down a lot, leave it alone. But if you've got a fund that's breaking through outrageously high, any types of stocks or funds you can think of that might be up a lot now in the news? How about technology or growth funds, AI, or companies that do a lot of technology and things? Because the S&P 500 was down a couple of years ago because the Fed started raising interest rates, people lost patience. I'm getting out of the S&P 500 index. I'm going to go buy CDs. And then all of a sudden, people thought, oops, I need to get back into the market. So then the S&P went from a decline of 35% up 40% in the last 12 months or so. I think it's more like 29%, but somewhere in there it was a higher number. So what we want to do on a biannual basis is sell off some of what's gone up too much where we think this isn't going to last, and then buy into the other stuff that have dropped too much where we don't think that's going to last. During the pandemic, energy stocks tanked. We had tankers out in the ocean with oil, right? They couldn't give the oil away. Well, we bought into some clients into energy funds that had dropped 50, 60%. And at that point, it made the dividend, what used to be 3 or 4%, was now twice that because you paid half the price for the shares. So when the market crashed during that time, we harvested some conservative funds that didn't drop much and bought into energy or technology or whatever else was down a lot. So on a biannual basis, that's where we reallocate and we sell off what's gone up too much and reallocate into something else that's dropped a little bit too much to try to rebalance things. Because that one that's up a lot could drop a lot. I've even done this with utility stocks, right? They were up like 32% one year when they normally should be up maybe 10 or 12. So we sold off utilities and bought into whatever was down at the time. Because parts of the investment economy are broken into sectors. I'll try to think of some of them, but you have oil or energy, you have technology, you have utilities.
Consumer discretionary and staples.
Consumer discretionary, consumer staples. We bought into consumer discretionary last year at this time only because it was down 35%. It had stocks like Microsoft, it had Home Depot, so all the things that people could choose not to buy. Consumer staples, they had to buy grocery store stock or products, right? But consumer discretionary, you didn't have to buy, and if you thought the economy was going to keep falling, you just stayed away from them. So we reallocated some money into consumer discretionary only because it was down 35%. I'm only talking 1 or 2 or 3%. And if it drops further, we'll buy a little more because sooner or later, Home Depot and Microsoft and Walgreens and all that are going to come back. So you rebalance it. So on a biannual basis, whatever's up too much, we sold off and maybe bought a little bit of consumer discretionary. And then since then, we're up like 30, 33%. But it was a guess. It wasn't a, I'm so smart, it's going to go up. It was an educated guess and a good rebalancing, and you get paid back a little bit. But you might rebalance when your stocks are up too much, rebalance them to balance into something, maybe cash or bonds or more conservative stocks, and the market keeps going up. So there isn't gonna be a one-off where you just make a fortune unless you're willing to gamble. And anybody that's gonna gamble, which we have a problem with these managed high fee funds, I don't wanna pay somebody to gamble our money. If they have a strategic way to do things, that's fine. But I don't wanna have somebody be picked to gamble. So biannually is selling off what's up too much, buying what's low, rebalancing for the most part. And then annually, it's a good idea to review and re-evaluate everything about your situation. At the end of the year, how's your cash flow and expenses? What can you stop paying money on, and what do you have to buy more of, right? And then on an annual basis, auto insurance, homeowners insurance, and all that. One of the most valuable pieces of information is the most boring pieces of information. For example, your auto insurance, right? We all have liability insurance in case you get in a wreck and you get sued. You don't want to lose what you own. Your retirement accounts are usually protected. Your home has about $650,000 of homestead protection. So unless you have a lot of rentals or other monies outside of a retirement plan, you're probably in pretty good shape. But you still want to have high liability on your car, $300,000 to $500,000. Now, there's another reason that you want that high liability, and that's uninsured, underinsured motorists, right? What does that do? If somebody hurts you and they have no insurance or not enough, then theirs will be brought up to the level that you have on yours. Well, what do I need that for? That's ridiculous. Well, I had a client in the 80s that had $15,000 of insurance on his car. I had him up it to $300,000. What? I'm paying more for $300,000? That's crazy. But he had uninsured, underinsured. He's riding his bike, not driving in a car, and gets hit by a car. He's in the hospital. The agent comes to him and gives him $15,000 from the bad guy's insurance, because that's all they had. And the bad guy didn't have any assets. So my client's got $15,000 and he's got a compound fracture and he's not going to be let out for a few days. Can't work. But fortunately, by doing financial planning, he got the $300,000 uninsured, underinsured, and his own company had to write him a check for $285,000. I finally had money to invest for him. Sorry that we had to get it that way. But the financial plan covered that. Now, who needs the uninsured, underinsured motorist more? An older retired person or a young person, if you had to choose?
Young person.
And why?
I'm not sure.
Well, your intuitive answer was perfect. The younger person, this is what we want you to do in our classes. We say pass this on. Pass it on to the younger person, because if a younger person gets hit walking through the walkway, I had another client got hit by a car and had to use their own uninsured motorist. They have decades of being disabled if they're that seriously injured, right? And so $500,000 isn't a lot, but it's 10 years of $50,000 a year, or 20 years at 25 plus the growth. So they need that uninsured, underinsured motorist, not even if they're super cautious. I drive a Volvo. Volvo drivers never get in wrecks. That's because we're hyper about it. And Volvos may not be any safer, but we have less wrecks because we're hyper about it. So at this point, if the younger person gets injured, they're going to get a big wad of money if it's serious injury that they're going to need. Then, of course, we're not spending a lot of time on it, but encourage the younger people to get all the disability insurance that they can buy. And again, hopefully, if they're not disabled, it's a waste of money. But if they are, they have decades to live being disabled. If we're already retired and we are disabled, we might already have retirement income and or other things. But that young person hasn't accumulated an estate yet, so they don't have the resources that we do. Obviously, both people need the maximum coverage all the way down the line, but the younger people are the ones that get overlooked. And while we're on this, pass it along to the younger generation. Make sure that if they travel, they get travel insurance, not for their lost luggage, but for medical and medical evacuation. I've had clients travel out of the country, and one swinging on a vine broke and landed on a rock and broke their back. You had to buy 3 first-class tickets to get home. Other circumstances where somebody's injured, and one was a loss of life, but In Mexico, they wouldn't release the body for less than $25,000. Or other people that have gone on trips. One guy went to Peru, 5,000 feet elevation in the airport, started having blood clots because he had a history of stroke. So they flew him home and the insurance covered all that. Another couple had COVID, covered it. So if you travel, but especially younger people, and especially them, because they're the ones that are apt to get hurt. Although 3 weeks ago, I talked to a client who went to Germany. She's 76, fell and broke her hip. Fortunately, but unfortunately, the dog pulled her real hard. She didn't just trip, so it wasn't her fault. We always worry about that, right? If I forget something, I don't care. Just tell me I don't have dementia or anything. But she was injured. She had to have her hip operated in Germany. Her insurance here didn't cover it. Fortunately, Germany has a socialized medicine, so her cost was only $5,000. But she had to write a check, and then also, fortunately, she has a lot of money. But if it's young people in a third world country, yes?
You were saying it's travel insurance, and then there was a second kind that has to do with travel?
Yeah, if you buy travel insurance, make sure there's provisions for medical care and medical evacuation.
Thank you.
Yeah, really good. And again, those are one of the little things that can wipe you out. And then obviously check on all your security, cyber risk and all that. So if a relative calls, help, I'm here, I need money, I'm captive, now they can fake their voices. So you gotta be careful of that. And if they travel, make sure they drop their limits on their credit cards. Some people get drugged and then they use the credit cards. Whole nother story. So daily listening to what's happening with taxes and interest rates, assumed. Weekly, are the funds having any problems, any news about them? And then monthly, shop for new ones that have lower costs and better things that you're looking for. Quarterly, look at the list of funds and then start looking at, kind of get rid of any of these if they're not performing. Now, performing is another story. If the S&P isn't performing, it's because the S&P is down. It's not the fund's fault. But if it's a fund that's not performing when everybody else is, you want to look at that a little bit closer. So quarterly, look at how's everything doing? Do I need to get rid of some because I'm not happy with what they're doing, or are their expenses just too high? Biannually, sell off things that have gone up too much. We do that semi-annual rebalancing. And then annually, look at all of your, like we mentioned, cash flow, insurance, taxes, reevaluate whether you should do conversions for the Roth IRA. And nowadays, just start looking at YouTube videos. Should I convert a Roth? They'll tell you 10 reasons you should and 10 reasons you shouldn't. And find out which ones match what your needs are. And become good friends with your accountant if somebody does your taxes, because anything that you do radically is going to hurt you if you're not planning that, right? There's things that can happen. Remember during COVID, the government said you don't have to do your R&Ds this year? Remember that? For people that were 70 and a half or 72 or whatever, a required minimum distribution, when you reach a certain age, you're required to pull money out of your IRA. That way the government can finally tax that money. So it used to be age 70 and a half, now it's 72, then it went to 73. They changed it a lot. But at that point, when the market crashed, the government said, you don't have to pull money out on a mandatory basis this year if you would normally have to do that. Any ideas of why they waived that requirement? The biggest reason would be some people, unfortunately, had all their money in stocks. Some people, unfortunately, had all their money in one stock. And that stock was down, let's say, 50%. Okay? And they didn't have the cash in the account. So they had to pull out, let's say, 5% of the old value back in December. So if you had 100,000 back in December, you got to pull out 5,000. But now that 100,000 is only worth 50. And I got to pull out 5,000 and it's only worth 50. That's not fair. So the government waived that requirement. Now, if we have a properly diversified portfolio, remember, you have short-term money, intermediate, long-term. So we always got money available if the market crashes. That's the planning process. It'll slow your growth a little bit, but it's worth it. That's insurance that we have without having to buy insurance. So you're gonna look at those things biannually and annually, come back and look at all of those diagnostics. They're all listed in the book, and you can flip through and just review them. Because again, you may be spending money you don't need to. I need to do that on subscriptions and things that you don't use anymore, especially online and all that stuff. And then they automatically renew, right? Or there may be insurances that you no longer need, but some that you might want to buy, whatever that is, maximize the liability of things we talked about. And then tax planning, watch some videos on year-end tax planning. And then you go into estate planning.
Could I ask you one quick question?
Sure.
All that rebalancing can frequently trigger tax.
Exactly.
So, I don't know, I can't imagine there's some magical strategy you can manage to sort of deal with that. Is it just a matter of if I rebalance, I'm gonna have this tax, I may gain this advantage by rebalancing, but I'm gonna have this loss because of, is that what you do? And
Yes.
Is it worth it? Is that the kind of process you go through?
Yeah, so it'll depend kind of on the specific situation, but if we just use the example of just say you have an individual brokerage account that doesn't have any tax benefits, so any tax liability you're gonna feel that year. If you're in that situation, generally, for the most part, again, most of the focus is gonna be on what the purpose of the investment is. So if it's a short-term thing, we're probably gonna be only looking at interest-bearing securities, but let's just say, for example, we've got long-term goals and we've got this big diversified portfolio, we've got positions with lots of gains. A lot of the times, as long as it's relatively within your targets allocations, you don't necessarily have to make a change. But one of the things that you can do is if you have some funds that are doing well, some that are doing more poorly, gains and losses can net each other out. So if you have gains on a certain position, like if your growth stocks are doing really well, and you feel like they've gotten a little too overbalanced in your portfolio, maybe you've got emerging markets or energy or something that's taken a hit over here. If you sold both of those positions and they were equivalent gain and loss, you actually won't have any tax results at all. It'll just be flat. So you won't actually have any consequence from that. But yeah, if you're still trying to stay within your targets and you have to rebalance to do that, you are just gonna have to take the tax hit. There's not really anything magical you can do to get away from taxes. I mean, they do say the only two things that are certain in life are death and taxes, so it is something you will eventually have to face and pay, but it just kind of comes down to how are you going to navigate on the way towards that.
And it should be an individualized thing, because if you have a fund that's up 5,000, one that's down 5, like Nash said, you could sell both of them and equal out and no taxes. But the one that's down, what if it rebounds? So if we sell the one that's down, we need to buy something else just like it that stays within something called wash rules, but something very similar. So let's say I have a real estate fund, a legitimate one that's traded in the market, and it's down 5,000 and I sell it, and I go from this real estate fund, I need to buy another similar real estate fund that isn't exactly the same, but is similar. So when it rebounds, I don't lose that rebound. And the thing is though, now what this was, and I sold it at a loss, and I buy this one here, now I have this gain to pay back. You know, it's not free unless I avoid taxes. Now, there's one way you can avoid taxes on capital gains. Totally avoid it, and that asset could be sold, but you have to do one thing first. Does anybody know? You got a house, real estate, a mansion, they've all gone up in value, and you've got stocks that are up in value, and if you sell it, you've got huge taxes, right? We're all, investors are sometimes stuck with real estate properties that if they sell it, there's a gain, or they could do an exchange, but there's high fees. They wish they could just sell it and not pay any taxes. There is a way you can sell stocks or real estate or anything else that's appreciated significantly tax-free, but what do you have to do?
Trust.
That would make sense. The unfortunate answer is you have to die.
Oh,
Right? And then you get something, your beneficiary gets it all tax-free. Is that bizarre? You spent a lifetime accumulating this stuff. If you sell it, it's taxable. Now you can sell a real estate property and do a 1031 exchange, but you have commissions, new property taxes, all that stuff. But if you sell it, you pay the tax, but your beneficiary sells it, they inherit it at the full value and they don't pay any taxes if they sell it. Now that law is always under attack, but right now that's unfair, right? If, while we're on the topic, if you had anything you wanted to give younger people, then you just gift it directly and then they sell it at a lower tax bracket, or if it's a charity. And there's trusts and things that Nash knows about that you could donate money to, and they sell it, no taxes, you earn the income and all that kind of stuff, but we won't bother you with that. So these are a lot of things that either you or somebody that's managing the stuff, a partner or a family member is doing. They need to at least be able to say, yeah, I've got an eye on these things and I'm aware of what's happening. Because 2 years ago, and even before then, in all the classes I've ever taught, I always said stay away from long-term bonds. You could buy a 30-year treasury bond today at what, 4.5? You could lock in 4.5%, 30-year treasury bond. If you have $1 million, you get $45,000 a year. State-wise, it's not taxable, but it is taxable on the federal side. But after I bought that 4.5% bond, what if new treasuries came out at 5.5%? Well, it doesn't affect me. I just keep collecting my $45,000 a year for the next 30 years, or I could sell it to somebody, but the government's not going to cash me out for 30 years. But if rates went up to 10% on new treasuries, who on earth would want mine at 4.5 if I wanted to sell it? They could get 10 and I can only give them 4.5, so I'm going to have to lose half of the money if I want to sell that bond within 30 years, if rates are still high. So we've always said stay away from long-term bonds. 2 years ago, those people who didn't heed the warning lost 20 to 40% because they did have average broad market bonds that dropped 20%, or if you were really aggressive, had you bought these 30-year treasuries, you were down 40%. Now, if you think interest rates are stable or going down, you buy a 4.5% 30-year treasury, great, and rates drop to 3.5 on new treasuries. Now people are knocking at your door wanting to buy that bond from you. But you're going to offer that bond at a little bit of a premium and make a little excess money. So that's, you know, whatever turned out to be beneficial for you. But we recommended to stay away from it. We watched other advisors panicking because they had their clients in broad market bond funds that dropped 20% when interest rates went through the roof. And because interest rates were higher on CDs, people dumped stocks and they went over and bought CDs. So stocks and bonds combined were down 20+%, where the bonds shouldn't have been down more than a few percent. Ours, finally, after 43 years of me singing "The Sky's Falling" with bonds, I've been saying that because I started in 1980 and rates went up really high by 82. We saw bonds drop 50%. So I've been screaming that warning for 40 some odd years. And so we were in short-term bonds when the market crashed, and our bonds weren't affected very much at all. Nowadays, if the Fed's not going to raise rates much, and the government can't raise rates because they'll go broke paying higher rates on future treasuries, now we're open to the possibility of little longer-term government treasury bonds that pay that same rate, but it'll stay there if short-term rates fall. So if you buy CDs right now, what are the interest rates on CDs? Maybe 5% if you get one at 5. That's a possibility. But overnight, if that 1 month, that 3 month CD could mature, boom, you're down to whatever they're maturing at. If that's your fear, then you buy a 6 month, a 2 year, a 5 year CD, and when rates fall, you laugh all the way to the bank. But we don't know. It's all political or it's economic things can happen. So you balance things out as best we can. Here's a few planning ideas. This is in the book, and it's just kind of for fun. But this is a stair step. So if taxes were an issue, there are money market funds out there that pay a tax-free interest rate, probably 3% or so. So if you're in a high tax bracket and you just say, look, I just can't, they're killing me, I've got a big government pension, I've got a big 401k thrift savings plan that I have to start pulling out, I've got rentals that help me, I'm in a high tax bracket, money market fund here because you can
in the old days, write a check. You can transfer money out very easily, but you earn interest tax-free. And it floats with the market, up and down. Not bad. Vanguard has them, good company. Then tax-favored index funds or exchange-traded funds that buy municipal bonds. So this one has shares you can buy and sell as fast as you want to, but internally the bonds have a life on them, 6 months, 2 years, 5 years, whatever. So here we're looking at bonds that are municipal bonds, either all in the state in which you live in, adds to the risk, or diversified among municipal bonds throughout the country. But the main thing here is, although the value can fluctuate a little bit, this is our tax-free savings account and municipal bond funds. Exchange-traded funds preferably, if the costs are lower. Then stage 3 is tax-managed growth fund, one where they try not to trigger too much in taxes, or an index fund, which usually doesn't buy or sell. They slightly rebalance to keep up with the percentages, weightings. And then exchange-traded funds, which are very tax efficient for reasons we don't have time to go into, but they're more tax efficient at that point. Now, these first 3 are mentioned because all 3 can be sold and liquidated. If I have a brokerage account and I want to sell my ETFs and I want my cash, how long does it take? I called today and say sell if everything got sold.
It'll take 2 days for the cash to settle, and then depending on your withdrawal process, however long that takes, so another few days. So
Wire.
about probably within a week.
So these 3 you could call up and if you, oh no, the market's tanking, sell, and right away they'll sell it, you go to cash. And then you can get your money back within about a week. But the reason that these 3 are here is to provide immediate liquidity. You immediately need the money. It may or may not be where you want it, but you can get the money back. Then you go to step 4, tax-deductible retirement plans. Those technically aren't liquid. You could actually get the money, but you would have massive taxes, right? Ordinary income tax, state, federal penalties. The federal penalty is 10% for an early withdrawal if you're under 59.5. Everybody here is, right, except for me. And state, what's the state tax early withdrawal penalty for an early withdrawal in a retirement plan? 2.5%. So I think you have a combine of state and federal 12.5% if somebody pulls it out prior to 59.5. Now there's exceptions. If I'm disabled, I can pull money out without a penalty. And if I'm not earning income, the taxes probably aren't going to hurt me too much. But these remain immediately liquid, and then this one would not be if it's a retirement plan. Personal residence obviously is not immediately liquid if you wanted it. And we don't worry about the values because we live in it, and your house could go up and down. Someday they're going to have like Zillow, they'll probably have, is it non-fungible tokens or something? So, yeah, someday you'll be able to buy mutual funds instantly, right?
Possibly.
So like the blockchain and then all this stuff. Someday you'd probably be able to sell your house instantly without having to go through escrow and all that stuff. Well, we're not going to do that. We don't care what the value of our house is. We live in it. We're emotionally attached. And it's non-liquid. Then the next step up would be the Roth version of an IRA. Senator Roth came up where you put money in this IRA. You don't get a tax deduction, but it grows tax-free, right? And a Roth you could do with a 401k and a Roth tax sheltered annuity. So that's another one that is not immediately liquid because you got to leave the money in for 5 years or more. You have to be 59.5 before you can pull money out. But it is a great icing on the cake to add to your other retirement plans because if it accumulates, you can pull it out someday tax-free. Now, you might choose to do a conversion from your regular IRA to a Roth, not for your benefit, but for whose benefit?
Your kids when you die.
Yeah, perfect. So you pay the taxes over time, they get all the benefit. Maybe they get too much these days. Okay, good. But that's the other reason, if you're a single individual and you don't have somebody to take care of, a partner or something, if you buy long-term care insurance, it's primarily for the benefit of the inheritances, right? Because if something happens to you that's severely enough, you're going to go to long-term care, you don't care who's paying for it. But if you want to protect future generations and inheritances, you go out of your pocket to buy long-term care insurance. But it's reducing your lifestyle for them to benefit? I don't know. So we'll let them pay the premiums if they want you to have it. Then tax deferred annuity, a low or low cost. Annuities, if you have one, not a problem. I wouldn't recommend ever buying one. They're like the bank making money off you, which we know they're making money off us, so that's fair. But the insurance companies give you a 10-year surrender or a 15-year surrender penalty. See, can you imagine if you go into the bank and say, I'm going to put all my money in the savings accounts, and I know, bank, you're making money off me, but you're giving me whatever's fair. You understand that? But if they say, that's fine, but by the way, you can't have your money for 10 years without a substantial penalty, then you start thinking, this isn't working for me. Well, the bank is saying, but we need time to make money, and we'll give you a little extra bonus here and bonus there. Stay away from the insurance products, in our opinion. The best annuity that exists would be Social Security, because that's fair. If I die, you get my money, but not some insurance agent that charges a big commission, or you don't see the commission. Oh, you don't pay the commission, the company does, but it comes out of your high if you leave early, because they need time to make money off you. Then commercial real estate, better than personal real estate, because people can move in and they don't have 30 days, like you see these squatters and things like that. Commercial, the judges are real tough on tenants if they don't pay the bill. But if you have residential, you're going to have problems. The last one is personal business, biggest risk, but most profitable if it succeeds. So these things kind of give you, and it's in the book, if you have a tax issue, most liquid, tax deductible, and long-term positions. Converting to a Roth, we talked about a little bit already. You'll see it in the book. If you're in a lower tax bracket today than the future, converting sounds good. But if you're going to be in a higher tax bracket, in a lower tax bracket, you do it now. In a higher tax bracket, I'm getting backwards. If I'm going to be in a higher tax bracket, I do it now. If I'm going to be in a lower tax bracket, then why worry? Why bother with it? But that's a relative question that you have to ask yourself. But I do have to admit, it's possible tax rates could go up in the future. Maybe not right away and we fall off a cliff. We should have, but it's something to consider if you're doing any conversions. And there's all kinds of rules out there we don't have time to talk about that Nash and his mom deal with every day of inheriting a Roth, inheriting this, inheriting that. The rules change almost every year. But before you do anything, you want to fully analyze it. This will be listed in the book on page 133. If you are doing where to invest your investments through retirement, if you had a large rollover 401k, and that's all the money in the world you've got, 100,000, 500, a million. How do I take money out of this without running out? Well, the insurance companies will pat you on the head, don't worry, honey, we'll take care of you. Give us all your money and we'll give you so much money a year. But that's irrevocable, and they're pulling your money out for the first 20 years, or the first 10 or 15 years. Your money's coming out that they're paying you, and if you die, they keep the rest. It's better to have your own money and pull your own interest or dividends and or principal. But some people get nervous and they say, what do I do? I talked to a guy yesterday. He's got an amount of money that's enough that it'd be okay if he pulls out 4%, but should he put all the money in CDs? Well, that's fine in the short term if the market crashes, but what if inflation goes up? He's like barely 59. So we need to invest for growth, but if we go for growth, what if the market crashes and all of a sudden he's starting to liquidate losses? That's a problem. So you can do something like this. We call this an income for life. Is the first year for this guy that's got money, his first year distribution, he might leave in cash and just pull out, let's say in this case, $1,000 a month is all he needed. Right? House is paid for, he's got other things. So the first year's distribution is in a money market or a cash fund, and he gets that $1,000 a month. The next year is invested for 2 to 3 years in long-term CDs or money market funds. Lock in the yields, but don't touch it for after the first 12 months, and then start liquidating a little bit. So the first year and into the second, third year, volatility is not a fear. We're not scared, right? Then in the third year, if he had short-term bonds or funds, floating rate, a lower credit rating but higher yields, and high-yield bond funds, jump on funds that give you higher yields, but if they fall by the third year, they've already earned such high yields, if it's reinvested, that'll absorb any downturn, hopefully. Then in year 5 to 7, intermediate term bonds, balance funds, they have stocks and bonds, but they've had 5 to 7 years to accumulate, rebound, or reinvest dividends, so not too bad. Then in year 7 to 10, equity income funds, meaning stocks, equity is another word for stocks, blue chip stock funds and total return funds, they're kind of a good balance. But they're not going to be touched for 7 to 10 years. Historically, the market's usually recovers in a couple of years, but 2 to 5?
Depends. Yeah.
Okay. And worst case is we've seen 10 years from 2008 on. It took almost 10 years. So 7 to 10 years equity or blue chip Warren Buffett type dividend paying funds, and they've got 7 years that if they did drop right away, 7 years to recover, and then 10 to 15 years stock related funds like growth funds, international, and other sectors like real estate and things like that. Now, every year or two, you have to reshift things around, and that's where you would rebalance strictly for the risk level. But with rebalancing, if you ever hire somebody to manage your money, go to a big company out there that says, for a fee, we'll manage it. If it's not a retirement account, if you move money around, you pay taxes, possibly. You may have some write-offs. But if you go to a company like that, they put you in a predetermined allocations, we call it a bucket, and everybody goes to the same thing. Now that this PhD intellectual person at the home office says, gee, I think let's sell that and buy that in the bucket. And everybody sells this and buys that. Well, they don't care about your taxes. They just want to keep it rebalanced. And so now you might have a serious problem. I've had clients that have been really mad that they went to a big company that was advertised. The company rebalanced everything immediately to be in their little allocations, and the tax hit was horrendous. So that's why you, a family member or an advisor, you need to do the allocations based on your timing, your risk tolerance, your liquidity needs. That's why we don't like the across the board unless it's small clients that can't afford to pay a fee or they don't have enough to worry about yet. But when you get up into a bigger portfolio, it needs to be rebalanced properly, but based on your tax situation, risk tolerance, and liquidity needs. So this is the income for life model that if somebody said, I've got to have money here because I'm only 40, 50, 60 years old, or 70, I need some long-term growth potential because look, we had inflation at 9% a year. So I can't overlook this. Now the one thing that most of us have done to protect that is to buy the house you're living in. You're not necessarily buying it for appreciation, you just don't want that if prices go up, that your cost of living goes up, right? You locked in your mortgage payment, or maybe paid the house off, keep the taxes the same. But it's an inflation protection, so if you were renting, I couldn't afford to buy my house I bought 29 years ago. And I sure wouldn't want to rent it, right? So we try to buy as much as we can, and if you're renting now, you have a good situation, that works too. But long-term stuff we've got to have here, and short-term stuff we've got to have there, and then the balance of everything else.
Could I ask you a question?
Yeah.
Except for the first year, do you basically take whatever the first year amounts to and then divide the rest by 5 and put it into each of those buckets? Is that how you're allocating? Because you're putting money into those buckets now, aren't you?
Yeah.
So that you get in your long-term 15-year bucket has been working since year 1.
You could, however, the amount that goes into this bucket, you could analyze what do I need to meet the income needs based on a smaller dollar amount if it grows. Does that make sense?
Yeah, so there's, the ways that we'll do it is it's mostly based on how much risk you're gonna try to take. So generally, what happens is if you say that you need $50,000 in cash every single year from your investments to pay for retirement, let's say. If that's your situation, then there is a particular dollar amount based on some assumptions that we'll make, based on the assumptions of how much return we'll make, how much inflation is, some other things. And we'll assume that we can then create a dollar figure that we need to arrive to. Then, based on historical data, we look at how much risk we need to be taking in order to arrive there at that given time. And we will adjust how much goes in each of these sections based on how much risk we need to take. So if we need to take more risk, we'd invest in more stock funds, more equity funds. If we don't need to take as much risk, if we've already got 75% of the money and we still have 20 years to go, we might not need to put so much money into stocks, and we can leave more of it in short-term, intermediate-term bonds. So it's a factor of how long you have, how much risk you need to take, and some other assumptions based on economic conditions.
Yeah, and specifically, let's say this other guy needed $1,000 a month, 12,000. You wouldn't put 12,000 here because you would end up possibly with 24 or 35,000 at that point, maybe more than what you need. Then again, inflation could be worse, so maybe you need it. But if you were just say, let's just stay with I need 12,000 a year at that point, then you would take the amount of money you're going to need here and make it smaller, giving it room to grow. So there's a lot of different angles, and none of which are going to be right. Because the inflation didn't go up as much, I didn't need as much, or I needed more or less, or it did go up or whatnot. But we try to do the best allocations that we can. But you could say, I want $12,000 a year for each little model, and whether it's way too much money or not, I don't care. That's another way you can do it. But the problem with investors is we tend to rush over to, if the market crashes, we want to sell what's down and go buy something that's safe. And that's human behavior. It's absolutely human. We follow tribes. I'm sorry, politics makes that very obvious, but we go from one tribe to another. We feel safer. The Custer's Last Stand, remember that? I've seen analysis, and the guys were supposed to be spread out, but they all got scared and came together, and then they were wiped out. Something I guess in battles you're not supposed to do. So we want to avoid following the crowd, and if you plan things ahead of time, this could be just a model that you do just for your investments, just in case. But we have the short-term, the intermediate, the long-term positions to make sure that we're in pretty good shape. So that's talked about in the book. I don't think there's an actual chart there. This is one that gives a similar idea of risk, kind of like when you're in an airplane, you hit turbulence 30,000 feet up or something. They're uncomfortable, but it's not life-threatening. So if you have investments that are far away from coming in for a landing, then the volatility is not much of a problem. But as I get closer to coming in and cashing this money out and spending it, then I need to slowly lessen the volatility over time. Most retirees shouldn't be all the way down to bonds and money market funds. This would be a good example of a college fund. The child is just born, aggressive growth funds, now they're 5, now they're 10, now they're 15, now they're getting ready to pull some money but not sure, and then when we're gonna write the check to send them to an expensive school, we want to be back into money market funds because time is a problem if they need all that money to buy the education. So almost done with this part. We are done. We love questions. Is there any questions to finish up with? Was it too complicated or pretty much in there? Okay. We'll go a little bit more into the exchange traded fund and the investments that are available to you either on your own or if you have a family member or an advisor work with you. We want to make sure that nobody pulls the wool over your eyes on getting advice or help out there. And we have various opinions. We don't think your tax accountant should sell you mutual funds type thing. The attorney shouldn't sell you annuities. You got to stay away from this stuff. And all of the stuff we're talking about today, anybody could do if you wanted to spend the time. But if you don't want to spend the time, then you seek out and get some help. But go to the website, you can watch the first 6 classes of the other class that we do at Sac State, and you can enter the class out there on Fridays, 1 o'clock, or other classes that are more fun. It's called the Renaissance Society at Sac State. Is that what they call it? So just look up Renaissance Sac State, and this is a group for people that want to attend a variety of classes. Ours is the only one that's all technical and serious. There's other more fun classes, but people that have gone to college and are now retired love to go out there. You get the college experience again. But there's a ton of other classes. You join them for $100 and then you go to any classes that you want. If you want to come to ours halfway through, more than welcome. And we invite the students to come out there, but they don't show up because we want to teach them what kind of future they can have in the business. So we have these little things, take a look at them. The handouts were kind of fun. Try that little test if you'd like. The book can be downloaded off the website if you want somebody else to have a copy or take an extra one here. Flip through it and enjoy the content there. Are we done? Okay, we're done. We'll see you next week. And we'll get a little bit deeper into the investment funds. But thank you so much for coming. I'm glad COVID's over and people are coming.
Thank you.
Thank you.
Thank you.
Thank you.